One handle, two platforms. That handle is the only fingerprint they can't forge. If anyone DMs you for money, wallet addresses, VIP access, or signals, it's a scam. I sell nothing. Ever. Now type WHO in the comments if you're actually locked in, because silver just went from 96.43 down toward the mid-80s in a single session, and on some screens it felt like $96 to $83 in 24 hours. And the internet's calling it an Iran war pump and dump. Here's the truth. If you treat this like a conspiracy story, you'll miss the real lesson. And you'll be the one providing liquidity next time. This wasn't magic. This was market plumbing inside a bullish structure. Both can be true at the same time. Stop. This matters. Because your FX Empire source literally gives you the clean timeline of the pump and the dump in one paragraph. Silver exceeded last week's high, printed $96.43, reclaimed a resistance zone around $94.24, then sellers took over and dropped it below Friday's low to 86.51 the same day. That's the move. That's the whipsaw. That's the pain. And FX Empire doesn't pretend it looked bullish in the moment. They call it not bullish short-term behavior. But they also say the bigger posture is still bullish because price is consolidating above rising moving averages and the structure looks constructive after a bearish correction. So right there is the entire truth they're hiding in one sentence. Silver can be structurally bullish while still doing violent liquidation moves that feel like betrayal. Now, your Kitco link adds the missing macro key to why the rug can pull when everyone thinks war headlines guarantee metals up, the US dollar index rallying, and risk aversion somewhat abating, with gold losing altitude and silver down sharply. Even without every paragraph of that Kitco article text visible in the scrape, the title alone is the mechanism. When the dollar rips and risk-off abates even slightly, silver, because it's thinner and more leveraged, can get hit harder than gold. So here's what we're doing today. We're extracting the material from FX Empire and Kitco and turning it into an engaged, weaponized map. No fluff, no headings, pure voiceover. And I'm going to answer the two questions your title promises. What actually happened, step by step. And who profited? Not names, not accusations, position types. Because markets don't need villains. They only need you positioned wrong in a volatility regime. Now listen, the crowd saw $100. The crowd smelled a headline. The crowd chased. But the market doesn't care about your excitement. The market cares about liquidity and collateral. So it did what it always does in silver. It lured late money in near a round number magnet. Then it yanked the floor when the outside markets flipped. Let's start with FX Empire's map, because it's specific. They say silver has been consolidating above rising moving averages after a bullish breakout. They say the 10-day moving average crossed above the 20-day, and the 10-day is poised to rise above the 50-day. That matters because it tells you the bigger trend engine is still pointed up. Then they explain why bulls even dared to think 100 and beyond. They point to a bullish breakout of an inverse head and shoulders reversal pattern triggered a couple weeks earlier, leading to the recovery of moving averages, a sign of growing demand. And they go even further. They say that demand suggests silver may eventually challenge the recent record high around 121.67. So the structure is bullish. Now comes the trapdoor. They describe the exact day. Price pushes up, breaks last week's high, hits 96.43, and even recovers that resistance zone at 94.24. Optimism for bulls. Then the buyers fail to retain control. Sellers take over. Silver drops below Friday's low down to 86.51. That's not a gentle pullback. That's a liquidation-style move. And FX Empire says the next likely target after that Monday extension was the 61.8% Fibonacci retracement at 99.66, basically the $100 magnet. So pause, this is crucial. If the market is staring at 99.66 and silver is already above $94 and printing 96ers, what happens? Breakout chasers pile in. They want the screenshot. They want the race to $100. They want to say they were early. That's the pump behavior. But the pros see something else. They see a crowded magnet level. They see thin liquidity. And they see a market that just came off a sharp 47.6% drop, meaning volatility is baked in. FX Empire literally says this advance is in reaction to a sharp 47.6% drop. So when volatility is high, the market doesn't move in smooth increments. It moves in cliff edges. Now, FX Empire gives you the blueprint for where upside could go if the bull structure resumes. They calculate a pattern target near $105.56 from that head and shoulders bottom. And they say, given recent volatility, the 78.6% Fibonacci retracement at 114.49 has a chance of being reached too. So what do you have? A bullish roadmap. with a trapdoor. Now bring in the outside market key from Kitco. Gold loses altitude, silver down sharply, USDX rallies, and risk aversion somewhat abates. That is the pull the rug catalyst class. Because in a war-driven tape, everyone assumes risk-off is linear. It's not. Risk-off comes in waves. Sometimes fear spikes, then stabilizes. Sometimes stocks bounce. Sometimes yields move. Sometimes the dollar rips. And when the dollar rips, silver feels it first. Because silver is not just a metal. Silver is a leverage positioning vehicle. Now, you titled it Iran War Pump and Dump Exposed. So let me say this clearly, and keep it credible. Your sources do not prove a coordinated criminal pump and dump. What they show is a headline-driven momentum surge colliding with outside market reversals and leverage flushing, which can look like pump and dump behavior from the outside. That's the adult framing. Now the fun part, who profited? Here's the only honest answer. Not a secret list of people. Position types. Because markets don't pay identities. They pay positioning. Here are the position types that tend to profit when silver does this exact whipsaw. First group, early longs who sold into the spike. FX Empire tells you the advance from the 64.06 low in early February was orderly and constructive. If you were long from that zone, the 94.9060 print was not a must-buy. It was a take profit into chaos zone. The crowd buys the breakout. The early money sells the liquidity. That's not evil. That's how markets function. Second group, mean reversion shorts and hedgers at the magnet. FX Empire highlights the next likely target at $99.66. When a market gets close to a major magnet like that, pros often fade it with tight risk, because they know breakouts attract emotional money. If the breakout fails, stops cascade, and cascade days pay the fades. Third group, dollar bulls. Kitco's headline tells you USDX was rallying as risk aversion abated. In that environment, long dollar positioning benefits and dollar-priced commodities face headwinds. Silver usually gets hit harder than gold because it's higher beta. Fourth group, volatility traders. Anytime you get a move that can print 96.43 and then dump to 86.51 the same day, volatility sellers and buyers both can win depending on structure, but the real winners are the ones who understood volatility was the product. Fifth group, the quiet winner, unleveraged holders with patience. This is the one nobody brags about. But leverage is what converts volatility into forced liquidation. If you weren't forced, you didn't have to sell into the low. So who profited? Anyone who wasn't forced to make decisions at the worst time. Now stop, pattern break. The biggest lie in silver is the belief that uptrend means smooth. Silver's uptrends are made of trapdoors. And those trapdoors are not bugs. They're features. They shake out weak hands. Now let's expose the actual mechanism that makes this look like pump and dump without needing a conspiracy. Here's the loop. War headlines hit. Silver runs because it's the small, fast, hard asset. Price approaches a big round number magnet. FX Empire literally shows the magnet at $99.66. Breakout buyers chase, stops cluster under obvious intraday supports. Then outside markets reverse. Kitco's headline describes it. USDX rallies, risk aversion abates. When USDX rallies, silver often drops. When silver drops, volatility rises. When volatility rises, leveraged traders get margin pressure. When margin pressure hits, they sell. That selling hit stops. Stops cause more selling. And suddenly you're not down 1%, you're down 6% or more. That's the dump. Now, FX Empire gives you the critical detail. Despite that ugly day, the structure still matters, and they define support levels you can actually use. They say key near-term support is last week's low at 84.94 and the rising 20-day moving average at 82.49. That's your adult map. Because if the market dumps into that zone and holds, it's often a flush. If it breaks and can't reclaim, the unwind isn't done. Now I'm going to translate all of this into a tight 48-hour checklist that your audience can actually follow. This is where your retention goes up, because people stay for a mission. Here it is. First, the support test. FX Empire flagged 84.94 and 82.49 as key near-term support. If silver holds above that region and stabilizes, the selling was likely mechanical. If silver slices through it and can't reclaim, the flush is turning into something deeper. Second, the reclaim test. FX Empire highlighted the recovered resistance zone around $94.24. If silver can reclaim that zone after dumping, bulls are still in control. If every bounce fails below it, the market is still de-risking. Third, the $100 magnet behavior. FX Empire put the 61.8% retracement at $99.66 as the next likely target after the extension. If price starts grinding back toward it with lower volatility, the $100 door is still alive. If price spikes toward it and gets rejected violently again, then $100 is being used as a distribution trap. Fourth, the outside market switch. Kitco's headline frames the day, USDX rallying, risk aversion somewhat abating, gold losing altitude, silver down sharply. If the dollar keeps strengthening, silver stays under pressure even if the long-run structure is bullish. If the dollar cools, silver gets breathing room to resume the bull structure. Fifth, rebound speed. This is the most important tell in silver, not the size of the bounce, the speed. Fast rebound after a slam means buyers are waiting. Slow bleed means demand is absent. Now let's tie the who profited question back into the psychology, because that's what makes this video go viral. The people who profited are the people who weren't hypnotized by $100, because $100 isn't a guarantee. It's a magnet. Magnets attract crowds. Crowds create liquidity. Liquidity gets harvested. That's markets. Now I'm going to give you two scenarios, binary, so viewers feel the stakes. Scenario A, this was the flush before continuation. Silver holds the 84.94, 82.49 support zone. Dollar stops rallying, risk off returns. Silver begins making higher lows again. Then the market comes back for 99.66 and possibly 105.56. In that scenario, this pump and dump look is just the leverage flush that reloads the move. Scenario B. This was the start of a deeper unwind. Silver breaks the support zone and can't reclaim. USDX keeps rallying like Kitco's headline suggests. Risk aversion continues to abate, and silver keeps bleeding because the leverage cleanse isn't done. In that scenario, the market will need time to rebuild before it can attack $100 again. We don't guess which scenario it is. We watch the checklist. Now stop. Pattern break again. This is why silver is the devil's metal. It forces you to choose between conviction and comfort gets punished. So if you're building a channel, the best service you can provide is not silver to $300. It's teaching people to survive the path, because survival is the edge. Now let's close this out in the OG style you trained. 3 takeaways. 1, FX Empire documented the full whipsaw. Silver hit 96.43, reclaimed 94.24, then dumped to 86.51 while still saying the bigger posture remains bullish due to consolidation above moving average support and a recent inverse head and shoulders breakout. 2. FX Empire's roadmap shows why $100 is the battleground. The next likely target after Monday's extension was 99.66. 61.8% retracement, with potential pattern targets near 105.56 and even 114.49 in a high volatility continuation scenario. 3. Kitco's framing explains how the rug can pull. USDX rallying and risk aversion somewhat abating can pressure metals, with silver often taking the harder hit. And here's the cliffhanger. When silver hits the 84.94, 82.49 zone, does it bounce fast or does it slice through like there's no bid? That one answer tells you whether this was a pump and dump look or the leverage flush that sets up the next leg. This isn't financial advice. This is financial warfare education.